Accelerated benefits. Riders attached to life insurance policies that allow death benefits to be used to cover nursing or convalescent home expenses. Accidental death benefits. A policy rider that states that the cause of death will be analyzed to determine if it complies with the policy description of accidental death. Accidental death insurance. An insurance policy that provides payment if the insured's death is the result of an accident. Accumulation period. The time before an annuitant's retirement during which the annuitant is making payments or investments in an annuity. Actual cash value. ACV. The required amount to pay damages or for property loss. This amount is calculated based on the property's current replacement value minus depreciation. Adhesion. A contract offered on a take-it-or-leave-it basis by an insurer, in which the insured's only option is to either accept or reject the contract. Any ambiguities in the contract will be settled in favor of the insured. Adjustable life. Life insurance that permits changes in the face amount, premium amount, period of protection, and the duration of the premium payment period. Admitted, authorized, insurer. An insurance company authorized and licensed to transact business in a particular state. Adverse selection. The tendency of risks with a higher probability of loss to purchase and maintain insurance more often than the risks who present a lower probability. Agency. An insurance sales office or company. Agent. An individual who is licensed to sell, negotiate, or effect insurance contracts on behalf of the insurer. Agent appointment. The authorization of an agent to act for or represent an insurer. Agent's authority. Special powers granted to an agent by his or her agency contract. Aleatory. A contract in which participating parties exchange unequal amounts. Insurance contracts are aleatory in that the amount the insured will pay in premiums is unequal to the amount the insurer will pay in the event of a loss. Alien insurer. An insurance company that is incorporated outside the United States. Annual statement. A detailed financial report that an insurance company must submit every year to the Insurance Department of states in which it conducts business. Annuity. A contract that provides income for a specified period of years, or for life. Apparent authority. The appearance or the assumption of authority based on the actions, words, or deeds of the principal or because of circumstances the principal created. Applicant. A person making application for, or offering himself, herself or another to be insured under an insurance contract. Application. A document that provides information for underwriting purposes. After the policy is issued, any unanswered questions are considered waived by the insurer. Assignment. The transfer of ownership rights of a life insurance policy from one person to another. Attained age. The age of the insured at a determined date. Attending physician's statement, APS. A statement usually obtained from the applicant's doctor. Authorized, admitted, insurer. An insurance company authorized and licensed to transact business in a particular state. Avoidance. A method of dealing with risk by deliberately keeping away from it, e.g. if a person wanted to avoid the risk of being killed in an airplane crash, he or she might choose to never fly in a plane. Basic illustration. A ledger or proposal used in the sale of a life insurance policy that shows both guaranteed and non-guaranteed elements. Beneficiary. The person who receives the proceeds from the policy when the insured dies. Birthday rule. The method of determining primary coverage for a dependent child, under which the plan of the parent whose birthday occurs first in the calendar year is designated as primary. Broker. An individual who represents an insured in the process of purchasing and negotiating a contract of insurance. Buy-sell agreement. A legal contract that determines what will be done with a business in the event that an owner dies or becomes disabled. Buyer's guide. A booklet that describes insurance policies and concepts, and provides general information to help an applicant make an informed decision. Cash value. The amount to which a policy owner is entitled if the policy is surrendered before maturity. Certificate. A statement or booklet that confirms that a policy has been written and that describes the coverage in general. Certificate of authority. A document that authorizes a company to start conducting business and specifies the kinds of insurance a company can transact. It is illegal for an insurance company to transact insurance without this certificate. Certificate of insurance. A legal document that indicates that an insurance policy has been issued, and that states both the amounts and types of insurance provided. Claim. A request for payment of the benefits provided by an insurance contract. Coercion. An unfair trade practice in which an agent uses physical or mental force with the intent of inducing an applicant to purchase insurance. Coinsurance clause. A provision that states that the insurer and the insured will share the losses covered by the policy in a proportion agreed upon in advance. Commingling. A practice in which a person in a fiduciary capacity illegally mixes his/her personal funds with funds he/she is holding in trust. Commission. The payment made by insurers to agents or brokers for the sale and service of policies. Commissioner. The chief executive and administrative officer of a state insurance department, in some states, known as director or superintendent. Concealment. The withholding of known facts that, if material, can void a contract. Conditional contract. A type of agreement in which both parties must perform certain duties and follow rules of conduct to make the contract enforceable. Consideration. The binding force in a contract that requires something of value to be exchanged for the transfer of risk. The consideration on the part of the insured is the representations made in the application and the payment of premium. The consideration on the part of the insurer is the promise to pay in the event of loss. Consumer report. A written and/or oral statement regarding a consumer's credit, character, reputation, or habits collected by a reporting agency from employment records, credit reports, and other public sources. Contract. An agreement between two or more parties enforceable by law. Contributory. A group insurance plan that requires the employees to pay part of the premium. Controlled business. An entity that obtains and possesses a license solely for the purpose of writing business on the owner, immediate family, relatives, employer, or employees. Convertible. A policy that may be exchanged for another type of policy by contractual provision, at the option of the policy owner, and without evidence of insurability, i.e. term life changed to a form of permanent life. Countersignature. The act of signing an insurance policy by a licensed resident agent. Coverage. The inclusion of causes of loss, perils, which are covered within a scope of a policy. Credit life insurance. A special type of coverage written to pay off the balance of a loan in the event of the death of the debtor. Death benefit. The amount payable upon the death of the person whose life is insured. Decreasing term. A type of life insurance that features a level premium and a death benefit that decreases each year over the duration of the policy. Defamation. An unfair trade practice in which one agent or insurer makes an injurious statement about another with the intent of harming the person's or company's reputation. Dependent. A person who relies on another for support and maintenance. Director. the Chief Executive and Administrative Officer of the Insurance Department, in some states, known as Commissioner or Superintendent. Disclosure: an act of identifying the name of the producer, representative or firm, limited insurance representative, or temporary insurance producer on any policy solicitation. Domestic insurer: an insurance company that conducts business in the state of incorporation. Domicile of insurer: insurer's location of incorporation and the legal ability to write business in a state. Earned premium: the amount of the premium for which the policy protection has been given. Effective date: the date when an insurance policy begins, also known as the inception date. Employee Retirement Income Security Act, ERISA. The act that stipulates federal standards for private pension plans. Endorsement: a form changing the provisions of and attached to a life insurance policy, also known as a rider. Endow: to reach the maturity date or time at which the face amount equals cash values. Estoppel: a legal impediment to denying a fact or restoring a right that has been previously waived. Excess insurance: insurance that pays over and above or in addition to basic policy limits. Exclusions: causes of loss, exposures, conditions, etc. listed in the policy for which the benefits will not be paid. Expiration: the date specified in the policy as the date of termination. Express authority: the authority granted to an agent by means of the agent's written contract. Extension of benefits: a provision that allows coverage to continue beyond the policy's expiration date for employees who are not actively at work due to disability or who have dependents hospitalized on that date. This coverage continues only until the employee returns to work or the dependent leaves the hospital. Face: the first page of a policy. Fair Credit Reporting Act, a federal law that established procedures consumer reporting agencies must follow in order to ensure that records are confidential, accurate, relevant, and properly used. Fiduciary: an agent broker who handles insurers' funds in a trust capacity. Fixed annuity: an annuity that offers fixed payments and guarantees a minimum rate of interest to be credited to the purchase payment or payments. Flexible premium: a policy feature that allows the policyholder to vary premium payments in the amount and/or timing. Foreign insurer: an insurance company that is incorporated in another state. Fraternal benefit societies: life or health insurance companies formed to provide insurance for members of an affiliated lodge, religious organization, or fraternal organization with a representative form of government. Fraud: intentional misrepresentation or deceit with the intent to induce a person to part with something of value. Free look: a period of time, usually required by law, during which a policy owner may inspect a newly issued individual life or health insurance policy for a stated number of days and surrender it in exchange for a full refund of premium if not satisfied for any reason. Grace period: period of time after the premium due date during which premiums may still be paid, and the policy and its riders remain in force. Group life: life insurance provided for members of a group. Hazard: a circumstance that increases the likelihood of a loss. Hazard. Moral: the effect of a person's reputation, character, living habits, etc. on his/her insurability. Hazard. Morale: the effect a person's indifference concerning loss has on the risk to be insured. Hazard. Physical: a type of hazard that arises from the physical characteristics of an individual, such as a physical disability due to either current circumstance or a condition present at birth. Implied authority: authority that is not expressed or written into the contract, but which the agent is assumed to have in order to transact the business of insurance for the principal. Indemnify. To restore the insured to the same condition as prior to loss with no intent of loss or gain. Insolvent organization. A member organization that is unable to pay its contractual obligations and is placed under a final order of liquidation or rehabilitation by a court of competent jurisdiction. Insurability. The acceptability of an applicant who meets an insurance company's underwriting requirements for insurance. Insurable interest. A financial interest in the life of another person. A possibility of losing something of value if the insured should die. In life insurance, insurable interest must exist at the time of policy application or policy issue. Insurance. A contract whereby one party, insurer, agrees to indemnify or guarantee another party, insured, against a loss by a specified future contingency or peril in return for payment of a premium. Insured. The person or organization that is protected by insurance. The party is to be indemnified. Insurer. An entity that indemnifies against losses, provides benefits, or renders services, also known as company or insurance company. Insuring clause. A general statement that identifies the basic agreement between the insurance company and the insured, usually located on the first page of the policy. Intentional injury. An act that is intended to cause injury. Self-inflicted injuries are not covered under accident insurance. Intentional injuries inflicted on the insured by another are covered. Investigative consumer reports. A report similar to consumer report, but one that also provides information on the consumer's character, reputation, and habits. Issue age. The individual's age when a policy is issued. Joint life. A single policy that is designed to insure two or more lives. Juvenile life. Any life insurance written on the life of a minor. Lapse. Termination of a policy because the premium has not been paid by the end of the grace period. Law of large numbers. A principle stating that the larger the number of similar exposure units considered, the more closely the losses reported will equal the underlying probability of loss. Level premium. A policy premium that remains the same over the period of time premiums are paid. Life expectancy. Average number of years remaining for a person of a given age to live, as shown on the mortality table. Life settlement. An arrangement that allows the policy owner to sell their existing life insurance policy to a third party for compensation. Limited pay whole life. A variation of whole life insurance that charges a level annual premium and provides a level, guaranteed death benefit to the insured's age 100 and will endow for the face amount if the insured lives to age 100. Limited pay life is designed so that the premiums for coverage will be completely paid up well before age 100. Liquidation. Selling assets as a method of raising capital. Living benefits rider. A rider attached to a life insurance policy that provides lieutenant colonel benefits or benefits for the terminally ill by using available life insurance benefits. Lloyd's associations. Organizations that provide support facilities for underwriters or groups of individuals that accept insurance risk. Loan value. The amount of money an insured can borrow using the cash value of his/her life insurance policy as collateral. Loss. The reduction, decrease, or disappearance of value of the person or property insured in a policy, by a peril insured against. Lump sum. Settlement method that pays the beneficiary the entire proceeds of a life insurance policy in one payment rather than in installments. Market value adjusted annuity. A single premium deferred annuity that allows a contract owner to lock in a guaranteed interest rate over a specified maturity period. Maturity date: the date when the face amount of the life insurance becomes payable. Medical Information Bureau (MIB), an information database that stores the health histories of individuals who have applied for insurance in the past. Most insurance companies subscribe to this database for underwriting purposes. Misrepresentation: a false statement or lie that can render the contract void. Mode of payment: the method of premium payment, whether annually, semi-annually, quarterly, or monthly. Mortality table: a table showing the probability of death at specified ages. Mutual companies: insurance organizations that have no capital stock but are owned by the policyholders. Non-admitted, non-authorized: an insurance company that has not applied for, or has applied and been denied a certificate of authority and may not transact insurance in a particular state. Non-authorized, non-admitted: an insurance company that has not applied for, or has applied and been denied a certificate of authority and may not transact insurance in a particular state. Non-cancelable: an insurance contract that the insured has a right to continue in force by payment of premiums that remain the same for a substantial period of time. Non-forfeiture values: those guaranteed values in a life insurance policy that cannot be taken from the insured, even if he or she ceases to pay premiums. Non-medical: a life or health insurance policy that is underwritten based on the insured's statement of health rather than a medical examination. Non-participating policies, non-par: insurance that does not pay dividends. Non-qualified plan: a type of benefit plan that may discriminate, is not required to be filed with the IRS, and does not provide a current tax deduction for contributions. Non-renewal: a termination of a policy by an insurer on the anniversary or renewal date. Non-resident agent: an agent licensed in a state in which he or she is not a resident. Option: a choice of ways of receiving policy dividends, non-forfeiture values, death benefits, or cash values. Overinsurance: an excessive amount of insurance that would result in overpayment to the insured in the event of a loss. Paid-up insurance: a policy on which all premiums have been paid but which has not matured due either to death or endowment. Participating policies, PAR: insurance that pays dividends to policyholders. Payer benefit: a rider found in juvenile policies which waives the premiums if the person paying them, often the parent, is disabled or dies while the child is still a minor. Peril: the cause of a possible loss. Permanent life insurance: a general term used to refer to various forms of whole life insurance policies that remain in effect to age 100 so long as the premium is paid. Persistency: the tendency or likelihood of insurance policies not lapsing or being replaced with insurance from another insurer. Personal contract: an agreement between an insurance company and an individual that states that insurance policies cover the individual's insurable interest. Physical exam and autopsy: a provision that allows an insurer, at its own expense, to have an insured physically examined when a claim is pending or to have an autopsy performed where not prohibited by law. Policy loan: a non-forfeiture value in which an insurer loans a part or all of the cash value of the policy assigned as security for the loan to the policy owner. Policyholder: the person who has possession of the policy, usually the insured. Policy owner: the person who is entitled to exercise the rights and privileges in the policy. This person may or may not be the insured. Preferred risk: an insurance classification for applicants who have a lower expectation of incurring loss, and who, therefore, are covered at a reduced rate. Premium. A periodic payment to the insurance company to keep the policy in force. Primary beneficiary. The person who is named as first to receive benefits from a policy. Primary policy. A basic, fundamental insurance policy that pays first with respect to other outstanding policies. Principal amount. The full face value of a policy. Private insurance. Insurance furnished by non-governmental insuring organizations. Proceeds. The amount payable by the insurance company, usually in the insured's death or when the policy matures. Producer. Insurance agent or broker. Pure protection. Insurance whereby premiums are paid for protection in the event of death or disability, not for cash value accumulation. Qualified plan. A retirement plan that meets the IRS guidelines for receiving favorable tax treatment. Rate service organization. An organization that is formed by, or on behalf of, a group of insurers to develop rates for those insurers, and to file the rates with the insurance department on behalf of its members. They may also act as a collection point for actuarial data. Rebating. Any inducement offered in the sale of insurance products that is not specified in the policy. Reciprocal exchange. An unincorporated group of individuals who mutually insure one another, each separately assuming a share of each risk. Reciprocity. A situation in which two parties provide the same help or advantages to each other. For example, producer A living in State A can transact business as a non-resident in State B if State B's resident producers can transact business in State A. Reduction. Lessening the possibility or severity of a loss. Reinsurance. A form of insurance whereby one insurance company, the reinsurer, in consideration of a premium paid to them, agrees to indemnify another insurance company, the reinsured, for part or all of its liabilities, including the insured's policies. Reinstatement. Restoring a lapsed policy to its original premium-paying status. Renewal. The automatic re-establishment of in-force status affected by the payment of another premium. Representation. A statement made by the applicant for insurance that he/she represents as being substantially true to the best of his/her knowledge. Rider. A written agreement attached to the policy expanding or limiting the benefits otherwise payable. Risk. The uncertainty or chance of a loss occurring. Risk classification. The process of placing an applicant for insurance into a group with similar risks and charging a premium that will be fair to the entire group. Rollover. The transfer of a distribution from one tax-deferred retirement plan to another. Salvage. Any property that is turned over to an insurance company as part of a loss settlement that becomes the property of the insurance company. Securities Act of 1933. Federal legislation that requires investment companies to register their securities with the SEC, and that defines what is considered to be a security. Securities and Exchange Commission, SEC. A federal agency that regulates the registration and sale of securities. Self-insured plan. An employer or group trust that provides the income benefits under a non-qualified plan. Solvency. A condition where an insurer has sufficient assets, including surplus, to satisfy liabilities and regulatory requirements. Speculative risk. A situation in which either profit or loss is possible, but where there is no certainty regarding the outcome. Straight life income. An annuity option that pays a specific amount for as long as the annuitant lives, also known as life only, or pure life. Subrogation. The substitution of one person in place of another with reference to a lawful claim, demand, or right, so that he or she who is substituted succeeds to the rights of the other in relation to the debt or claim, and its rights, remedies, or securities. Surrender. The discontinuance of insurance and the return of the unearned premium by the insurance company. Suicide clause. A provision in life insurance policies that states that if the insured commits suicide within a specified period, usually 2 years, from the policy issue date, the death benefit will not be paid, and the premiums will be refunded. Term insurance. A type of life insurance policy that provides coverage for a specified term, such as 10, 20, or 30 years. Third-party administrator, TPA, an organization that processes insurance claims or certain aspects of employee benefit plans for a separate entity. Total and permanent disability, TPD. A condition in which an individual is unable to work due to a disabling injury or illness that is expected to be permanent and prevent the person from engaging in gainful employment. Twisting. The act of inducing a policyholder to lapse, surrender, or switch policies through misrepresentation or incomplete comparisons to sell another policy. Underwriting. The process of selecting risks for insurance and classifying them according to their degrees of insurability so that the appropriate rates may be assigned. Unearned premium. That part of the premium applicable to the unexpired part of the policy period. Universal life insurance. A flexible premium policy that combines term insurance protection with a savings element that is invested for tax-deferred accumulation. Unlawful act. An act that violates the law and is thereby considered to be a crime. Variable annuity. An annuity under which the amount of each periodic income payment will fluctuate, reflecting the investment experience of the company's separate account. Variable life insurance. A form of life insurance that combines death benefits with a savings element that can be invested in a variety of investment vehicles. Waiting period. The period between the policy issue date and the date coverage begins. Waiver. The giving up of a right to claim something, such as a waiver of premium benefit. Waiver of premium. A provision that suspends premium payments under certain conditions when the policyholder becomes disabled. Whole life insurance. A form of permanent life insurance that provides a death benefit and builds cash value over time. Written premiums. Premiums on all policies written by the company during a specified period, whether or not collected. Yearly renewable term, YRT. A form of renewable term insurance that provides coverage for 1 year and allows the policyholder to renew coverage annually at an increased premium. This glossary covers a wide range of insurance-related terms. If you have any specific questions about any of these terms or need further information on a particular topic, feel free to ask. Thanks for watching.